What is up, everyone? Welcome back to the trading world. Today is December 3rd, 2025. We're going to be reviewing price action. Today was a Wednesday. I'm going to be talking about one of the biggest traps that exists with inversion for value gaps. And you may have had an inversion where you take it, happen, and it immediately goes to stop loss. And I'm going to show you how you can identify those traps. There's specific kinds of inversion for value gaps that from my back testing, you can pretty much tell that it's going to be a trap right off the bat, and I'm going to show you guys how you can identify those. So with that, hopefully you guys enjoy this video, and let's jump right into it. So today, I'm going to be talking, as well as talking about price action in general, I'm going to be specifically zoning in on a very specific inversion gap, and it is this one right here. So you can see that we get a sweep of this low. We had a drawn liquidity to the upside. We knew this was a drawn liquidity, the high of this void, because, well, you can see here on the 15-minute, or it was the 30-minute, we actually had a 30-minute CRT. So you can see how we have this range of down close candles. We get this sweep, or I guess we get this indecision candle, and then we start moving back up towards the CRT high. So 30-minute CRT back up, and as you guys know, when we have this instant dump like this, these are gonna want to get filled, right? Instantaneous dumps. Don't treat those as fair value gaps. Treat those as essentially like voids, because they're gonna act a lot more like a void and want to get filled than they will just like reject and go lower. These instant super fast gaps that happen to the downside or the upside, these typically want to get filled. Anyway, that's how you could have known the drawn liquidity was higher. That, along with the fact that the higher time frame is possibly in a buy model, right? So sell side of the curve, buy side of the curve, we have these low resistance highs that the market's dialed in on. Okay, so now the exact trade. Let's dial in on this 5-minute inversion for value gap, and I'm going to show you guys how I took a 6R trade, and I actually think it was 7R, and I actually faded this inversion, and I had a pretty good idea that it was likely going to fail. I'm going to show you guys exactly how I did that. So okay, we get this inversion for value gap. Now, what's wrong with this, first of all? Well, before we even get into like any actual specific the specific reason why it's not good, it closes so high, right? It closes so high, it's not worth the risk reward at this point. But that's not the real specific reason why. The specific reason why I knew that this was going to be a trap type of inversion for value gap is because, let's go down to lower time frame. This inversed, we closed, and you can see best on maybe the 5-minute, it closed, the inversion for value gap closed into this rejection block with SMT. So I knew, so you guys may remember from prior videos, when we have a rejection block and there's SMT with that rejection block, and that rejection block has ideally swept some kind of high. So if you don't know what a rejection block is, by the way, it is just the wick of a swing high. So here's a high in the market. The wick of this is the rejection block, right? So you can see here's a rejection block. We end up getting SMT with this rejection block. We had rejection block. We have SMT with this high all the way over here. And we have SMT with this high. So stacked SMTs, and all of a sudden, this looks very scary. It looks very, very scary to take this inversion when this rejection block with stacked SMTs is right here. And keep in mind as well, the rejection block swept out highs, making it a higher probability rejection block. So all of a sudden it's like, shoo, it's a trap. Like, this is a trap inversion for value gap. And this is something that I've seen in the market quite a bit where you'll get these inversion for value gaps that on paper look okay, besides the fact we close super high. But then when you get into the details, you realize, oh shoot, this is just being used to get people induced to go long so they can be faded using this Phoenix to the downside. So if you don't know what Phoenix model is, it is just a rejection block with SMT, and you enter at that rejection block and then target lower. And just to show you and like I said, I did take this live. I took it on the Leap account, so it was a competition account, not my real accounts, unfortunately. But I did take this, right? Check this out. I took this. You can see there's the sell. And I faded it. I faded that inversion. I knew that with this rejection block and stacked SMTs that it was likely to fail. So you can see here's the rejection block. We get that rejection block. So here's the inversion. Everyone's going long. Everyone's getting induced to go long. We put our limit order at the rejection block and we fade them. So just understand that sometimes inversion for value gaps are going to be used to induce and trap people into being long one way for an actual trade to go the other way. It's not going to always have. This is why trading is so hard, because it's like, obviously inversion for value gaps are objectively good. Like we know, like if as long as it's got good signature, good liquidity, like everything fits in with AMD, an inversion for value gap is a profitable model. It's a good trade. But it's understanding the context. Like you can't just blindly take inversions and not really understand what's going on. We had 1 minute rejection block. It swept out highs. It came with SMT with this high, SMT with this high, and then bang, all the way back to those lows. So hopefully this teaches you something about when these inversion for value gap trades that look on paper okay, when they fail, it feels like, oh man, why did it fail? Hopefully now you can look into the market and see, oh, that's why this inversion for value gap failed. That's why this one failed. And yeah, I've seen this happen quite a few times. I've talked about it before in other videos, but I think this is the first time I've really kind of hit home on this specific idea that sometimes the market will get an inversion for value gap that is just used to induce people to go long into a rejection block to then go back to the lows. So then I ended up taking another 7-hour trade here. I should have taken profit here and then re-entered right here. So you might be wondering what this is. Well, we had a first presented for value gap from Tuesday. So once again, you can use old first presented for value gaps from previous days. In this case, this was yesterday's first presented for value gap. Look at how the market interacts with it and respects it. It's not going to forget yesterday's first presented for value gap. The market's going to remember the previous day's first presented for value gap. So, as you guys know, I trade 15-second change in state off of the first presented for value gap. I call that my first strike model. It's just a name to give it because no one ever taught me how to trade it. I had to figure it out myself. But first presented for value gap, here's 15-second change in state. So once again, a change in state of delivery is candle body close above an old down close candle, or a series of down close candles. And so there you go. There's the change in state. You can see there's my entry right there, right at that change in state retest. And then my mistake here was that I targeted standard deviation and not the actual liquidity, right? This is something that it's something you realize over time as a trader. It's like standard deviations are only helpful when there's a drawn liquidity that aligns with them, right? I can't just say, oh, I want to target this projection because from what I've seen, the 7th projection is usually a pretty good target. But if it doesn't align with liquidity, it's not going to go there. So yeah, it worked out. You can see I got the entry. I didn't go break even like a degen, and I did get the exit, but that doesn't mean that I took this trade as ideal as I could have, right? I should have, instead of just targeting the 7th projection, I should have said, where is the actual draw on liquidity here? It's these highs, right? It's the end of this consolidation. So what I should have done is I should have taken profit here, right? So this is 4.7R, and then when we come back down, sweep out the lows, and then get the 15-second change in state again. Now I get another one. I get another 15-second change in state of delivery off of the first center for value gap that swept out these lows, and now same thing. I can get another trade. So standard deviations are only helpful, they're just projections when they align with an actual old high or low or range in the market. You do not want to do what I did here and say, okay, 7 projections up, let's just go there. No. Target the actual draw on liquidity, which in this case was these highs. So I should have just targeted those highs. Then we come back down into the first center for value gap again, sweep the lows again. And now we have another change in state of delivery on the 15-second. We can use that again to target these highs, and then now that's 4R, right? So you can see there's 7R, there's 5R, there's 4R. I should have caught those three trades. Instead, I just caught the 2. But yeah, unfortunately, like I said, this was on my competition account and not my real accounts. But I'm just trying my best, and I'm getting better. But yeah, I could go more in detail. I'm trying to figure out what else. I guess whoever made it to the end of the video, you get to see something cool that I've been looking at recently, which is this idea of a pyramiding model. And once again, just gave it a name to describe it because no one's ever really told me how to pyramid. Just have to figure it out for myself. So like once again, you just gotta name things sometimes. So yeah, whatever. I'm making names for stuff, but you gotta do that when no one teaches you, right? You just gotta let the market teach you. So this is an idea for how to trade the entire market maker model. So sell side of the curve, buy side of the curve, and trading every single segment of it at once. So, check this out. You could enter, at the rejection block, so this is Phoenix. Then when we come up, inverse this gap, you go break even. And now you trail your stop. Then when we come here, you use the same initial risk, so you don't have to risk anything else. There's no risking more than 1R. You're only risking 1R because at this point your risk is back to 0. Once we come up inverse this gap, your risk is back to 0. Now we come down, tap the fair value gap of the 2022 model. Once again, you might be like, where's the breaker structure? I don't see it. It's displacement, right? And we do kind of break out this high here, but it's about displacement. So we come back down, tap OTE, which is the 0.6 of this 0.6 something of this range, align with this fair value gap. Then there we go. We risk another 1R. When we come up, inverse this gap. Now we go break even. Now we're back to 0R. Then one final leg down into the breaker and fair value gap. And this is the third entry. Once again, now your stop loss is here. Still only risking 1R. Once again, the other ones are in profit at this point. So there's no risk on these other two. And then bang, enter. And then all gets taken off at the high. And you just got 15R, only risking 1R. It's crazy. It's crazy what is possible in these markets once you really, really get to the point where you're this good at trading. And we just got to keep going. So hopefully you guys thought this was cool or interesting, and I'm going to end the video here. Thank you guys so much for watching. There's always more to review, but I just want to make make these videos consistently. I'll see you guys in the next one. Peace out.